You're on here. Katie.
He's fine if he's going to be quiet there.
Katie, you take a break, please, and take me out. You go like right now. We know we heard you.
Oh my God. Oh my gosh. Hey Ryan, I don't have video because the hey guys, just give me just a second. We always have trouble starting this little Android app thing. I can't. What do you need access to? Desktop?
Android app.
Good morning. Good morning. Good morning. Oh gosh. Admit all. Awesome. Can you turn on my ring light, please? Just gonna, if you guys don't mind giving me just a minute to let people come back in or let people join us this morning. Well, you're all are quiet. Nobody unmuted themselves.
Good morning.
Good morning. Thank you. I'm gonna make good morning. I'm gonna make a few camera adjustments here.
Okay.
How can I send this link to somebody else? Let me post the link in the comments really quick for you. Oh, good Lord. It's like I don't even know what I'm doing over here today. My goodness. Okay, so there's the link in the comments. Good morning. Good morning. If it's the first time that you're in here with us, I do a lot of stuff on the whiteboard. So if my back is to you or you can't hear what I'm saying, you just have to unmute yourself and let me know. This basically stemmed from, I have some newer staff. They're new to me and new to the industry. And I had literally just registered them for UWM's success track. And hey, Tyler, what was it like the next day? Literally like the next day it was canceled?
Yeah, it was probably like 2-3 days later with COVID.
If that, yeah, if that, it was canceled. And I have a background in corporate training. In my prior life, I was a corporate trainer, not only in the restaurant industry, but in disaster restoration. So when homes experience some sort of catastrophic loss, fire, flood, water, hail, stuff like that, I worked for a company that was franchising their business. And so I was brought on as a franchise trainer, training franchisees how to run their business and their put together their corporate manuals and stuff. So what I decided is that I would kind of put on my own version of Success Track for my staff. And then I thought that actually was something I had been discussing with my husband since November about fulfilling a need within our industry with a lack of training for like processors and stuff. And I know that myself as a broker owner and originator, I always wait until I'm like sinking in work before I decide to bring help on, and then I don't really have the capacity to train them. And so I thought about the opportunity that we had right now. Even though it's very challenging to take 2 hours out of the middle of my day to do this, I felt like I had a unique skill set to provide the training and open it up in the broker community, but also put something a little bit more formal together, not only for my staff as a reference guide, but continuing to help other people down the road. So that is why and how you got to be with us today. Some of the training will be geared specifically, you know, because selfishly, right? Like I want to train my people, but the thought of it is that, you know, if I have people who have about 6 months of experience, then anybody that has a year to 2 years should be able to learn something from what I'm doing. I transitioned from a retail environment to broker, and there really wasn't training. I think it's one of the things that as a corporate trainer was really challenging for me to not have a lot of access to, or I had to go to a lot of different places to get it. So if you're joining me today, this is session 5. We've spent a lot of time already in the previous 4 sessions, which is about 8 hours of training, talking about the meats and potatoes of just how it works. One of the things that I really try to strive to do is bridge the gap between conceptually understanding what it is that we're doing and creating tangible processes, and teaching people with everyday language that's easy to understand, and also allows people to bring their skill sets with them, even though there's maybe not a lot of experience in mortgage or mortgage processing. Y'all, my screen is frozen. Am I frozen on your side? All right, give me 1 second. Am I on the 5.0? Well, probably not, because I'm never on 5.0. Oh yeah, I am. I'm on 5. Can we try the 2.4?
This one's on.
That one's on 2.4. So can you put that to 2.5 or to 5.0? Give me just a second, guys. I'm still frozen on this side. Can somebody unmute themselves and let me know if I'm unfrozen on your side?
Still frozen.
You're frozen.
Oh, good gravy. Give us just a second. Can we go to the 2.4 channel, please?
Frozen. You're still frozen.
Okay. We're going to switch our Wi-Fi channels. Give us 1 second. Let's see. No, says my internet connection is unstable. Oh, good Lord. Okay, so my IT department, AKA my husband, is gonna work on that. Can everybody hear me otherwise?
Yes.
Okay, perfect. Okay, so while he kind of tries to figure that out, I'm gonna just keep chatting with you guys. I may go to a screen share here really quick, so if my chatting gets a little bit sporadic or sparse, it's just because I'm trying to set up a second, get some windows open so I can share with you guys some screen sharing actually. Okay, so normally what I like to do is just recap what we went over in the last session, just so you kind of know, so you know where we're picking up off of. In session 4, we talked a bit about the loan estimate, when, how, the 7-day consummation rule.
Jackie,
Yes.
sorry to interrupt. You still frozen, and I just didn't know if you were supposed to still be or
Yeah,
not.
no. So my husband's going to be working on our camera.
Yeah.
So I'm just going to keep talking and then if it doesn't pop up by the time I go through the overview, we'll just go to screen share.
Okay, cool. Thanks. Sorry.
Okay, no problem. Thank you for letting me know. Okay, so give me 1 second here. Okay, so normally what I do at the beginning of every session is I just briefly go over what we talked about last time, so you know kind of where we left off and where we're going to be picking up today. So we talked about the loan estimate, when and how. We talked about the 7-day consummation rule, especially if you're using lenders with really quick turn times like UWF. We talked about the closing disclosure on a really high level overview. Please know that this is not intended to be a compliance class, but more of a best practice session. That's my dog. And then we talked about a little bit about appraisals, kind of the sweet spot for ordering them and why you want to order them when you order them at the very beginning, and what the conversation maybe sounds like with your clients. What I usually tell my clients about why we're ordering it so soon in the process is because typically in Denver, which is where we do the majority of our business, we're licensed in New Mexico and Texas as well, but even in non-peak season, our appraisals run about 7 to 10 calendar days. A lot of people freak out when we tell them that. I also explain to them, having been the #1 housing market in the nation, like 30 of the last 48 months, in the summertime in peak season, we were running oftentimes 14 to 21 days for appraisals. And in order to get it in 7 to 10 days, you had to pay a rush. Our appraisals were costing us between $800 and $1,100 with a rush fee. So what I typically tell the client when we're ordering it right away in the front of the process is I just explain to them how it works, which really is, we want to get the appraisal ordered because we want to get in line for assignment. Okay, I know that you are still doing an inspection and maybe you haven't completed your inspection resolution yet. I'm still frozen on the camera, by the way. Haven't completed your inspection resolution, but we need to get in line for an appraiser. If you guys don't get through the inspection process mutually with the seller, that's okay, we can cancel this. Okay, as long if the appraiser goes out and you guys cancel, that's fine too. We just want to get subject to trip charge. I've seen it anywhere between $75 and $175. Okay, the only time that you're subject to not getting a refund is once the report is fully turned in. Am I still frozen? Yes, I'm still frozen. Let me take the video off really quick and then put it back on. Oh, you know what? It's because you switched the channels into, hey, everybody see me now?
Yes, good job.
Yay, there I am. It's all right, it only took 2 of us. It's all good, don't you worry. Okay. Let me just get my stuff back up here. Okay. And then we talked about like the 5 data points, and really the objective is to try and get your submissions to include all the data points so you can get an early closing disclosure issued so that you can start that mandatory wait period as soon as possible. Okay. So today, when we were going, so what happened was last time I was going over that, I realized that there was something in day 3 that I actually hadn't gone over. So we're gonna pick up, if y'all were here last time, I was like, hey, make a note about that. We missed that last time and we wanna go back over. So what we're gonna talk about today is, where's my notes? We're gonna talk about when you're pricing a loan and you're doing borrower paid or lender paid, when can you go borrower paid? What does that mean? Can you switch between the two? And it's really important because as a loan officer or a loan originator, oh, for heaven's sake, this is how it's going to be today. As a loan originator or an LOA or an advanced third-party processor, these are going to be things that, you know, you may, depending on your position as an LOA or as a third-party processor, you may not have the authority to do this, but what's going to happen is a loan officer is going to tell you, hey, I need to do this, and your head is going to spin, and you're going to be like, awesome, what in the world did you just say to me? Because I have no idea. So that is where we are going to start. Give me 1 second here. Okay. Sorry, I'm trying to just make sure that the waiting room doesn't have people waiting. Okay. So we spent some time talking about pricing a loan last time. Does anybody who maybe wasn't with us last time and hasn't had a chance to watch a video have any general overview questions about pricing a loan? How does it work? Does anybody that was here last time or anybody in my staff want me to go back over this a little bit more?
I do.
Okay, couple people. All right. So we're going to do this first, and that'll roll us right into borrower paid and lender paid compensation. So, okay. When you are pricing a loan, so we've talked about before the different parameters of an application and a loan. But when you're pricing a loan, there's going to be basically bullet points or characteristics of the loan that's going to determine your pricing. And the reason that it's really good to understand this is because you're going to have a client that's going to call you and they're going to be like, hey, so I checked my Credit Karma, my score is like 678, and I want to buy a house that's 350. What would my rate be? And you honestly cannot tell them. And the best way to combat that is just educate them and just let them know, actually determine. So now some of you may your broker owners or your loan officers may not share the same philosophy as I do. And that is completely okay. Okay. But I'm going to share with you my philosophy, how I address these things. And maybe you can take a nugget of something away that will help you, or something that you find value in. Okay, so I tell, back in the day, and what most people who have ever bought a home, it was always sold to somebody that you qualified for a rate. This is what you qualify. And they always thought it was like a moving target. Like once you qualified for 3.5, that was it. No other options, that's what you qualified for, okay? That's actually not the case. So what we're gonna talk about, we're gonna dive into this really quick. Let me do something. You guys, give me just 1 second. I need to take this permission off so that I don't have to admit people when they come to the waiting room. So give me just 1 second, please. Okay, let me see if that works, because I'm going to have my back turned to the computer a little bit, and I don't want anybody to miss being in here because I didn't see they were in the waiting room. So thank you for being patient with me this morning. Okay. Okay, so the bullet points are the parameters under which you're going to have to price a loan are as follows, okay? So obviously their credit score. Now, rule of thumb, I am not associated with every bank. I don't write the rules, but for a high likelihood across the board, every 20 points, okay? Pricing changes every 20 points. So I'm going to have one price. Sorry. I was thinking too fast. Sorry. Okay. So any credit scores that fall in between 600 and 619, these are all going to be the same price, or they're going to all have the same adjustment for the credit score. So if somebody has a 610 or a 619 or a 604 and a 619, same, okay? That's going to have the same pricing adjustment. You're not going to see any better pricing for the loan until the FICO jumps up to the next 20-point bucket, okay? Now, the program, okay? Is this conventional? Is it FHA? Is it VA? Is it USDA? Okay, is it affordable? Jesus. And that would be your home possible and home ready. Okay. So what kind of loan is it? What's the program? And then what type? Is it a purchase or a refi? Okay. Is it a purchase or a refi? You see who just. You're also gonna, sometimes you're gonna see an adjustment for the loan amount. The bigger ones are gonna be if the loan amount is less than 100,000. You're gonna see more adjustments to the pricing if the loan amount is less than 100,000. Okay, and another big one, I mean, these aren't really in order of importance, by the way, okay? And then you're also going to loan to value, okay? So how much is the loan amount compared to the value of the home? Okay, so when Jimmy Jane, Bob, wait, so it was Jamie Jones, he's our taco shop cook. When he wants to call you and say, oh, my credit score is, Karma says it's 670, and I saw this house on Zillow, and I want to know what my rate's going to be. You have this, okay? You have this, you have this. There's absolutely no way you can do that. And so what you want to do is educate them, right? That we have about 5 or 6 bullet points that determine how your loan pricing is structured. Okay. Is everybody okay with this, y'all? I'm sorry about the ring light. I know it's right in the middle of what I'm writing. Okay. So now, we're going to go into screen share really quick. But let me make sure I don't have anything open that I shouldn't, like I did last time. Okay. Now, screen sharing with you all. That's not what I want you to see. I don't want you to see my email. Okay, so this is a rate sheet. Now, each one of those things that we just talked about, you're going to have what's called an LLPA, which is a loan level price adjustment. Street language, so the language we use is called a hit. What's the hit for 95 LTV? Okay. Let me actually, let me do this really quick because I feel like this is a better. So in here, it's called an adjustment. Okay, so in this particular loan, the interest rate has a credit of 2.083 basis points. Okay, when you're pricing a loan, what you're looking for is the loan with the credit that's going to cover all of your adjustments and your compensation. And that would be considered a par rate. So right now, we're waiving the underwriting fee. We're cash out, right? So it's a refinance. What type of loan is it? It's a refinance. They're getting cash out. Our loan to value is between 60 and 75 with a credit score greater than 740. So we're going to get a hit of 0.625 basis points. Then we also have another adjustment for FICO over 40 and an LTV 60 to 75. A month ago, this would have been a bullshit adjustment. Not so much today, okay? But we're gonna get hit a quarter, 0.25, we're gonna get hit a quarter. So our total adjustments, so they're gonna start with this pricing here, the 2.083, right? Subtract all of the adjustments, we still have a 0.75 credit. After our compensation, it's a charge to the borrower of 1.75. Does anybody have questions right here before we go any further? I'm assuming no questions, no news is good news.
Yep.
Perfect. Okay. So the challenging thing about this scenario that I'm showing you, what we would normally expect to see is this rate sheet to keep going down, okay? Keep going down, and the bigger the rate, right? So the bigger the rate, the bigger the credit. Ideally, what you would want is to find a rate that's going to cover all of this. Now, we'll tell you we're waiting for a change of circumstance on this one because it's actually not a cash out. So we're waiting for this adjustment to go away. Okay. So the objective is to find the rate that covers your compensation and the adjustments. Now, you just saw the rate sheet. You saw that it was a sheet that goes up and down. So normally what you're going to do is you're going to find the rate that covers all of the adjustments and either has the smallest credit or the smallest charge. It's kind of an anomaly to find the rate that is a zero. It's like when you go to the grocery store and you go shopping and your checkout is an even dollar. Like I bet we all could count on one hand how many times that's ever happened to us. Like it's so much of an anomaly that when it happens, you're like, oh my gosh, that never happens. Like my groceries are never around dollar, right? So ideally what you would see is, 3.5 after your comp and after all your loan level price adjustments, which are the 5 things that we just talked about, or 6 things, okay, that 3.5, maybe you have a little bit of a credit of like 0.087, okay? Now, you can say to the borrower, and what you will find when you're looking at the rate sheet is sometimes this one, 3.375, which is called an eighth, okay, it's called an eighth. Sometimes this does not fall at, like now maybe this one has a charge of an eighth, which for a lot of loans, that's not a lot of money. But sometimes what you might see is that this actually has like a really big charge, like 0.75. And I say a really big charge because we're in Colorado and our loan amounts typically are really big. So like if you have a $400,000 loan amount, this is $2,000. Okay, I'm gonna go to my calculator and show you this really quick. So I'm gonna share screen with y'all. Okay, so if we have a $400,000 loan amount, okay, and we've got that charge that I just put on the board of 0.575, that's of 100. Just follow me here. I'm not a real good math speak, my sister is. So we're gonna multiply it times, we gotta move the decimal to the left too, because it's of 100, so 0.00575. Okay. So this rate, you multiply this, move the decimal over 2, times your loan amount is the cost. So typically the rate difference here isn't going to be big, I guess, isn't going to have a big enough impact on the payment to justify the borrower paying $2,300 to go down an eighth in rate. Okay. Any questions about this and the math?
Just real quick, yes, I do. We moved it over 2 decimal points because why again? What made it 2 decimal points?
Because a basis point is a percentage of 100.
Oh,
That's
okay.
called a BIP or beeps.
So if it was a different number, so say the bips were 3. I don't know. So I don't know if that's a good example or not. So if it was 3, would it be moved over 3 spots?
No. Always of 100.
Oh.
Always of 100. So no matter what you have, so like for example, okay, so let's talk about comp. So if your broker comp is 2.5, okay, and your loan amount is 400,000, in order to figure out what the compensation is, everything is done on basis points. So in order to, going back to screen share, just hold on a second. Here we go. Okay, everything is basis points. So as a lender comp, it's gonna be 400,000, which is our loan amount, times, move the decimal point to the left to 0.025. That's our compensation on the loan at 2.5%. Okay, so everything that we do is done on basis points, which is a percent of 100. So whether it's the comp or the price, okay, so if the price, what you're normally going to see is, okay, so every lender does this a little bit different. If you're choosing lender paid in your pricing system, then the rate that comes out with the pricing that's like this is par. It covers your comp. Oh, God dang, that thing is, hold on a second. That's gonna, okay. Your rate, if you're in the system and you've already told it that you're gonna be lender paid and you see this, then 100% is always your target. That's no charge, no credit. Okay, but you have to make sure that you're in it lender paid, because if you make this mistake and this is borrower paid, it's a big deal. So like if you all of a sudden are looking at something and you're like, that rate is too good to be true. Yeah, chances are that's exactly right. It is absolutely too good to be true.
Okay, thank you so much.
Yeah. So anytime that you're doing any sort of calculation, whether it's your comp or the price, now listen, I'm teaching you the math behind it, but the systems will all do this for you. Okay, the systems will do all of this for you. There really isn't, other than when you're looking at the system and you go, oh shoot, what's, if I see this, okay, that's a credit because it's above 100. If I see this, it's going to be a charge because I'm trying to get to 100. Every platform is going to be a little bit different, and you understand how it works. And when you're in different platforms, you can get a better idea of like what am I looking at here. Okay, so lender paid, when it's lender paid, you're getting paid by the bank, right? Because you're pricing the rate with your compensation in the rate, and then the bank's gonna pay you. Now, we're in a really interesting environment right now with COVID that you can't always, for example, that rate sheet we just had, right? It stopped at 3.625 and that rate didn't cover our comp. It's becoming more common right now because, all right, we're gonna have a little economics lesson. Wasn't planning on doing this, okay. Because of what's going on with COVID and because of what it's created in our economy, it is expected that this is gonna have long-lasting economic effect. Because this has been classified as the beginning of our recession, which we were due for, if you follow any sort of economic expert in the field, we were due. We're very cyclical. Every like 10 to 12 years, we have some sort of recession. Our last one was the housing market crisis. That was our recession. And so what's going to happen is as we climb out of COVID and as people go back to work and as our economy does whatever it's going to do to rebound, right? However long we're in the recession, it's going to demand that rates remain low during the recovery period. Right now, rates are what we would consider artificially high based on everything that we would normally look for at the stock market or any other measure points, okay? It's artificially high for several reasons. Now, I'm no Logan Matsahashamati. I don't know how to say his name. I'm no Barry Habib. I'm no Anthony Casa. I'm no Mortgage Professional Magazine, okay? Everything that I'm telling you is stuff that I have had to learn myself by watching people like them. But in college, I did have exposure to economics and how it worked. And I have a certificate in international economics. So I do understand on a different level how these are impacting us. So right now, because of the scarcity of money, because of everybody going into forbearance and how that works and how that impacts banks, their rates are artificially high because of a supply and demand issue for the actual money in lending. The projection is that in the next 60 to 90 days, as we come out of this, is that rates are going to be much lower than what they are now. And if we continue to lock at higher rates that are artificially high, all those people are going to want to come back and refinance in 3 to 6 months as we start to climb out of this. And so lenders are really trying to cap how much yield spread premium. So any of the credit that's given on the rate is called a yield spread premium. So on that example, when we started with the two, here, let me do this. Okay, the credit that you start with, so it's in a negative, which means the credit, this is what's called a yield spread premium. Oh, get out of my thing, okay. This that we started with, this is called a yield spread premium. This is what the rate is paying before the loan level price adjustments. Okay, so what happens, this is a perfect example. Well, this loan officer is structured to charge the borrower a certain amount anyway, so don't get all in a huff that this loan officer is charging this client. It's structured that way. They talked about how they wanted to do it. But let's say we were trying to price a loan right now, and we just couldn't anywhere in the market find a rate that's going to cover all the loan level price adjustments and our compensation. So you can choose to, and here's how I explain it to my clients, okay? Let me move this down just a little bit so it's not in the, so you have what's called lender paid and borrower paid. Okay. If my compensation is 2.5, okay, then I'm looking for the rate that's going to cover the 2.5. Our loan amount is 400. Whoa. Okay, so if our loan amount is 400,000, then the rate would cover this, which is $10,000. Okay. For this first example, we're going to act like we were able, I started this off backwards. We're going to act like we found a rate that covers all this. Okay, so let's say that rate right now is 4.125, covers all of our loan level price adjustments and covers our compensation. Okay, but let's say the borrower was short money to close. This would be a reason that somebody might change it to borrower paid. Let's say the borrower has a seller concession and they're still short money to close. Okay, so I'm going to tell you the theory of how it works. It's not this simple. Okay, so we haven't landed the plane on this, and also keep in mind I'm not teaching you this from a compliance standpoint. If I decide to go borrower paid, let's say I'm only going to charge them 2 points, but we're not going to change the rate. So what happens is the borrower now gets this credit in line J from the lender, and I'm only charging them 2 points now, which is 8,000. Okay, which means that they end up with a, can you see that? Yeah, they end up with a net credit of $2,000. Here's the issue. This is why it's not that simple. You cannot use this to pay for this. So when you have lower loan amounts or really big loan amounts, this gets tricky, okay? If you have something like this, I would be more than happy to do a one-on-one with you, but for the sake of the class, I can't really dive into this. I just, in theory, want to explain to you how it works or why you would do something like this. Okay, does that make sense to everybody? Does anybody have any questions about this? Do you want me to expand on this a little bit? So they got 10,000 in credit, but I'm only going to charge them this. So they end up netting, they basically get the $2,000 that the bank was normally going to give me, I'm now giving to them. Okay. I'm assuming since nobody's taking themselves off mute, not asking, that there aren't any questions. Tyler, do you feel comfortable with this? Somewhat? Okay.
Yeah.
Yeah,
Kathy,
that was clear.
I have a question.
Okay.
Do you ever find then that the borrowers are not hip to want to pay you your comp when that happens? Like, that's my biggest concern, is that they aren't going to want to out of pocket that comp to you.
Well, here's the thing. They got a credit though. So what I tell them, and Jamie can attest to this because she's heard me say it like 1,000 times, is
Yes, ma'am.
we're kind of playing with monopoly money, and one hand ends up washing the other. So here's how I address that. I say to them, let's say the borrower has 8,000. They didn't have 10, right? Because if we had left it the same, they would have had to come to cash to close with for the extra 2,000. Just follow me here, okay? Let's say the borrower only had $8,000 and all of our numbers worked out, right? And that's why I'm charging them 8. What I tell them is that instead of them paying the closing costs, they're going to pay this to me. And instead of the bank giving this to me, I am giving this to them. And I tell them that they can see this on line J.
Okay.
Okay.
Because that's always my biggest fear, is that they'll be like, they'll not want to pay you. You know what I mean? So I'm like scared to death to ever do borrower pay because of that.
Don't be. It's just because you don't know how to explain it to them. That's all.
Okay.
That's it. That's it. That's the only, you know it, and you can structure the deal and it's going to be fine. You just don't know how to explain it to them. So here's the next thing we're going to do. So this is if you're doing lender paid, you're not, and you're not changing the rate or anything because your borrower is short cash to close. Okay. So this is a little bit down the line beyond the initial pricing. This scenario might be something like this. Now, let's say.
Jackie, can I ask you real quick?
Yes.
Do we do the loans normally lender paid, or is that doing borrower paid very common?
Okay. Before we jump into this next example, so that's actually what I was going to talk about next, but let's just jump into it right here. Each lender interprets this rule marginally different. So as a processor or an originator, if there is any question as to whether or not you may need to switch this to borrower paid down the line, you have to know with that specific lender what they allow. Now, you can go from lender paid to borrower paid, because in essence, the reason you would do that would be to lower the charge. There are some banks that say, we will not let you do this within the transaction. If you register and submit as lender paid and you need to go flip to borrower paid, then you have to resubmit. If you don't understand what I'm saying, that's okay. Just stay with me because we're going to jump into this next. Okay. You can never, and I like, now that I said never, like I'm second guessing myself, but You can never go borrower paid to lender paid.
Correct.
I know, but then I start to think about like the rules they teach you in life.
I know, and I just wanted to give you that
Nothing's
assurance.
always or never. Nothing's ever always or never. But you can never go borrower paid to lender paid. So in your best interest, unless you are structuring the deal borrower paid from the get-go, always go lender paid. Now, what the fork did I just say? Because I know that there are people on my staff that have no effing idea about what I just said. Perfect. That's great. Let me explain to you. Okay. Let's say, here would be some times when you would need to go borrower paid. Let's say you have a client that is not meeting the current debt to income ratios. Based on the rate that you were able to find that covers all the loan level price adjustments and your compensation, right? Because if you remember, give me 1 second here. Okay, so if you remember, right, we're looking for the rate that's going to cover our compensation. So after the loan level price adjustments, so we're going to have to go up and 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 up until we find the rate that covers everything. But what if the rate that we find that covers everything pushes us out of our debt to income qualifying? Let's say we have to have 3.75. Okay, we have to, or the deal doesn't fly. Okay, so that's the premise under which we're going to talk about right now. Okay. Let's say we have, on all of our loan level price adjustments, let's say we took a hit for loan to value of 0.25. We got a FICO adjustment of 0.375. We got a loan amount adjustment of 0.125. Okay. So we have a total adjustment of 0.75. And we're going to use that rate sheet that we just had. So what did I say, 3.5? We need to have 3.5 to make the deal work? Yes, no? Is that what I said? I don't remember.
I think you said 0.75.
3.625.
What did I say?
I think it was 3.6 or 3.725.
Let's do 3.75. We got to have 3.75 to make this deal work. Okay, so on the rate sheet, 3.75 pays a total of 2 basis points. Okay, so this is what we're working with. Okay, we have to have this or the deal is dead. We don't do the deal. Here's my philosophy. Making half my commission is better than making no commission. Okay, doing a deal or not doing a deal. Okay, so we're going to start with 2 basis points. We have 0.75 in loan level price adjustments. So we have a net credit, a net yield spread premium of 1.25. Okay, if I go lender paid, oh shit, I shouldn't have used that color. Okay, so if I go lender paid, right, I've got to now subtract my 2.5 from this, which is going to give me, I'm short 1.25. So the borrower would pay 1.25 points in origination. So let's do the math on that. Okay, on $400,000 loan times 0.0125, the origination charge, if I left it and went lender paid, right? So the credit of 1.25 didn't cover all of my comp, which means that whatever this doesn't cover gets passed through as a charge to the borrower. On 400,000, this is a charge to the borrower of $5,000. Okay. You're going to get beat up about that, most likely. Okay. They're going to ask you about it. They're going to go on Vetted VA. They're going to share it with people, and people are going to be like, what the fuck is that? Why is somebody charging you $5,000? And if you don't like my language, I'm sorry. You saw my picture when you came in here, and I have this disclaimer right here.
I love it.
Okay.
Love it.
Okay, so, and what if the client doesn't have on top of their down payment an extra $5,000? Okay, so here's what you do. Here is an option. I'm not going to charge my 2.5. Okay. Right now, the borrower is getting 1.25 in credit, which is a $5,000 credit. I can do one of two things. I can charge a 1-point origination, which gives them an extra surplus credit of 0.25. Let's see what that is. 400,000 times 0.025, oopsies, 0.0025. Okay, so if I charge them a point, sorry, I can't see. Okay, if I charge them a point, right? They still have this credit because they have this credit here. We started with 2. We subtracted the loan level price adjustments. We have a net credit left of 1.25. I'm going to charge them a point. They're going to have 2.5 left over. So they're going to have, okay, now listen. You can't use this to pay for this, but it's how you explain it to them. Okay. They're going to, basically, I'm giving them enough credit to cover my charge and give them an extra $1,000. The money they were going to use for their closing costs is going to be reallocated to this, and this is going to be reallocated to their closing costs. That's a lot of monopoly money, but does everybody kind of get the gist of it?
Video.
Yes, I'm good.
Okay. Now,
Thanks for explaining that. You may need to go over that a couple more 100 times, but thank you.
we will. We'll do it again. Okay.
Okay.
So the other thing that I can do, I don't have to charge a percentage. I can charge a flat fee. So I could just say, I'm just going to charge, let's just say let's say I'm doing a friend a favor or a family member. I want to make a little money, but I also want to make sure they're taken care of, right? Maybe I'm only going to charge $2,500. Okay. So the money that the borrower is going to use for their closing costs is now going to be applied here. The bank is going to give them $5,000 to apply to their closing costs. But when I'm talking to them and I'm saying, you're going to see this charge in box A, but you're going to see in line J, oops, sorry. You're going to see this credit. Okay. So here, I got it. I got the email from her. Okay, so. Tyler. How you doing with this?
Like 80% good.
Okay, let's do it one more time. Okay, now this is different for a refinance. It's way easier on a refinance. Okay, but so let's pick, let's go to, we're going to go interactive here. Screen share. Okay, somebody pick a rate on the sheet. Anybody?
Let's
3.5.
do, yeah, no, 3, yeah, 3.5.
3.5. Okay. Am I like right in my, I'm right in the hot, okay, right here. Okay. So 3.5%, what's the yield spread premium on this one? 1.826 is the yield spread premium. This is the credit being for the rate. or YSP. Okay. Now, let's do this. Okay, so our loan level price adjustments or our hits. So let's say we have a FICO hit of 0.25. Say we have an LTV hit of 0.5. And we have let's do this. We have a purchase, it's a purchase, okay? And the bank really wants that purchase, so they're gonna give us an incentive of 0.125. And let's say we have we went Freddie Mac because we needed to not put a percent in for the student loans, but we're going to take a hit for that of 0.0. Oh, let's do 0.375. I have no idea what this math is going to be. Okay, so we're going to start with, and we're going to take the total price, and we're going to subtract the 0.25. I should have picked an easier fucking number. Okay. 1.826 minus 0.25. Okay, so now right here, we have a running credit of 1.576. And then we're going to subtract this one. We have a running credit of 1.076. But then we got an incentive. Some banks run a monthly incentive. Awesome. Some banks want your purchase transactions and not your refinance transactions. So now we're going to add this one back in. So now we're going to be at, oh, God dang, the math. I'm not good with the small numbers. I'm good with the big numbers. Okay, 1.076 plus 0.125 is 1.201. Okay, and then we have a hit because we needed to do the Freddie Mac loan because we needed to use 0.5% on the student loans instead of a full percent. So we're going to take the 1.201 minus 0.375. And that's a net price of 0.826. So we're still in the positive here. Now, what I do is I try to find, so basically this rate covers all the loan level price adjustments. I have to have this rate or the deal doesn't work. This is the credit that's left, okay? On a $400,000 loan amount, it's not a lot of money, y'all. 0.0086. Oh, hold on, I forgot a zero. 400,000 times 0.0086. Okay, so this is only a credit to the borrower, $34.40. Now, I personally might say, I really need to make at least 1 point in order to make sure my brokerage makes money, but also take care of this client and get the deal done, right? So if I charge a point, which is equal to $400,000, oops, sorry, $4,000, I've found the rate that gives them just about enough credit to cover the 1 point origination I'm going to charge them because I'm not going to be able to charge them the 2.5. I mean, I could, but it's going to kill the deal. So we're not doing that. you may say, hey, I want to do this client a solid. I'm only going to charge them $3,000, and they net a $440 additional credit that can be used to apply. Does this also help? Okay. You will get better at this. Okay. You will get better at this. But now you understand the math behind it. You're going to get tripped up. You're going to get tripped up on this. It's not always an easy thing to do. And then sometimes it's just hard because the website doesn't make a lot of sense. Or the biggest question is when I go into a new lender portal, I'm like, wait a minute, is the pricing include the comp or not? Like, I just need to make sure, because that's a big mistake to make. And I've literally done a loan for $300 because I made that mistake. Like, I can't not close it. It was my mistake, right? Okay. Before we move on to the next topic, anybody want me to do another example? We feel pretty good about this.
I just had a question.
Yeah.
So when you were talking at the end of the 0.826 for the $3,440 credit, you said you were needed to charge a point, which was the $4,000. Would you charge them like the $560 then to get to your point? So instead of charging the $5,000 to get your 2.5, you'd run it down, get them this credit. They'd only have to charge them $500, which is possibly more feasible for someone else.
Well, so what happens is a loan estimate is like a running debit and credit. So what would happen is on the loan estimate, you would have like box A, which is going to show that I charge them the $4,000, which is 1 point. Okay. And then you might have, like, let's say you have your underwriting fee in here of $895. Okay. And then in this box, you have your title stuff. Like, say you have like a $350 closing fee and a $900 lender's title insurance, right? So these are all charges. And then in box J, they're going to get a credit. Where's my, hold on. Where'd my green marker go? Green is positive. Oh, for crying out loud. Oh, hold on, it fell down here, hold on. Okay, and then in box J, you're gonna see the credit of the 3440, which is the 0.826, right? And so really, like, these are all the charges, and then you get the credit, right? Like, in any transaction, this is never gonna go away. Like, that's gonna be in there no matter what, right? And this, depending on how you price the loan, may or may not be here. So really what you see is, yes, I'm gonna charge, these are gonna be all the charges, but then you're gonna get a credit to apply to this stuff. So for example, on a cash to close, right, the borrower may have needed, let's say the borrower needed $3,500 to cover cash to close. Okay. That cash to close is gonna apply to this and apply to this before this, right? Before we do this, right? Okay. So now when we give them the credit, this now is going to apply to this. And this is going to apply to that.
Okay.
Okay. Where you get tripped up, and you will do this. You will do this. If you haven't done it, you're lying. If you haven't done it yet, okay, what will happen is you will do this math in your head and be like, oh my God, I'm going to do them such a good deal. I'm going to charge them this, but I'm going to give them like this credit here. I'm going to make sure that, like, oh my God, this is so good. They're going to get $1,400 in credit. It's amazing. I'm bomb at my job. I can't believe I'm so good. But what's going to happen is that this is going to be too much credit. because you can't apply any of this to this. And if they only have $3,500 in closing costs, right? They only had $3,500. Now all of a sudden you're like, oh shit, in order to make this to work, I got to bring this down to here. And the borrower, I mean, it's still okay. You still do them a solid. You can lower the rate, or they apply this to a principal reduction. Fuck, PLE or PAL, principal. I think it's LE, principal reduction. Which means that they take whatever couldn't be used here. Let's say it was $1,400, like they couldn't use $1,400 here because it was more credit than could be applied to all the other closing costs. They take the extra credit and they pay the loan balance down with it. So it reduces their loan amount. That's what a principal reduction is. They're reducing the principal amount of the loan. Okay, but I will tell you, I did this like 3 times last year. You guys have been doing this for a decade. Like, you're gonna make that mistake and it's okay. And you're going to be hating yourself because you're going to make like $2,000 instead of $5,000. Like, it happens. It happens. But the reason that I can stand in front of you and teach you this today is because I've made this mistake a couple times every year. Been doing this 10 years, been in broker for 7, so I've done it a dozen times at least. But it's because I didn't know this math. And then like on a conceptual level, like I understood the math. On a conceptual level, like I understood the math, but I really wasn't ever shown like how actually the math is done or how it's applied. Okay, and how does that affect my pricing? Okay. Any questions about that? Sorry, does this help you in kind of being able to explain to borrowers when you have to charge, but also give them a credit?
Yeah, I think it's just when we kind of ran up against it, it was just making sure that you have the conversation like ahead of time. I think there's a magic to being able to like take the bullet out of the gun before you get shot with it kind of thing. So it does help to be able to have some common words used or, being able to explain it because they're not going to get the training we're getting, right? So how do you explain it kind of like you do with more of analogies or, back to where it's more common language so that it's not a surprise when they get this paperwork and they go, or they share it and then, they can't answer the questions or they don't understand it. So yeah, I think that was great. And I know you're helpful with being able to like case by case, explain, run it down. So thanks for offering, going in the future to real life scenarios. Thank you for that.
So the thing is, a couple of things is, the first thing the most sincere and uneducated borrower is going to ask you is, well, how do I, and it's so cute because they'll be like, so how do I pay you? And then you're like, oh, okay. So what I typically explain to people is that even if they've financed before, just a part of my spiel as an originator is I have a contracted rate with the bank, especially if they're purchasing. I say to them, hey, I have a contracted rate with the bank, just like your real estate agent has a percentage that they're going to earn on the property. Based on their percentage, typically I'm the one that's paid the least in the transaction. Real estate agents are paid their percentage, 2.5, 2.83, whatever it is, on the value of the home, and I actually get a percentage of the loan amount, okay? I have that contracted rate with all of my banks. Sometimes though, if we need to make some adjustments or we need to buy the rate down, or if there's some moving parts in there, I don't really want to get into all the details with you because it's like a weird mad science behind the scenes. But here's the deal. I'm just going to send you the disclosure with my contracted rate that the bank is going to pay me. If we have to make any adjustments down the line, I'll break it up for you and I'll show you. I always tell them where to find the credit. Because the first thing they're going to see is a charge because it's box A, and that's the first thing that they're going to see. And so I explain that to them before I even send it to them. I say, listen, I've decided that I'm going to put some money into the transaction to help us get to the finish line. So what I'm going to do is I'm actually going to lower the rate. It's going to reduce the amount of credit that the bank is going to be able to give us, but I'm going to reduce my compensation so that you don't have to pay that. The way that that's going to happen is before you didn't see anything in box A. In order to do this, we have to move money over into box A, what my compensation is. And then in box J, you're going to see the credit that the bank is going to give you. Now, we might have to make some further adjustments because it's all funny money. Like the money you were going to use for closing costs is now going to go towards paying what I have in box A, and the money in box J is going to cover your closing costs. It's just for compliance that it has to be that way. But as long as the bottom line irons out the same, then just know that it's, we've done a good job getting this back down to where you need it to be in order to close the deal. If you want me to go into further explanation about that, I'm happy to. But we'll probably just wait until we get the revised loan estimate showing those numbers. Otherwise, it's a little bit hard to follow the math. But if I go into it and I'm like, so you're gonna see, like in box A, you're gonna see like a $7,000 charge. Now I know that's a lot. I know it's a lot, but if you go to box J, then right. So really taking on the role of educating them, because think about when you go. So say this is a really good example. If anybody's in here has ever bought a vehicle right before the beginning of a year. So for example, if you bought a new vehicle like in December, January of 2020, but you bought a 19 or an 18 model, the sticker price at the top doesn't change. They don't reduce the price. You just slap on a really big incentive down at the bottom because they want to get rid of the old year models, or they want to incentivize you to buy the new year model, right? So it doesn't change the price of it. They just give you a bigger credit in the line items down at the bottom. It's not really like anything, like when you go to Kohl's, they ring that shit up at full price. And then at the bottom, they take the discount out. So like you're standing at Kohl's and you're scanning and that shit gets up to like $400, but then they're like, oh, that'll be $97.25. You're like, whoo, just getting worried there a little bit before you took all them discounts off, right? So those are some common everyday examples that you can tell people, be like, hey, you know what? It's funny, actually. It's kind of like when you go grocery shopping at King Soopers or Smith's or Fry's or Head, you don't put in your loyalty card and they charge you full price for everything. And then you put your card number in at the end and then everything starts reducing. It's kind of like that. And so the first thing we want to do is panic right away. Just know that like the discount or the credit that you're getting is going to be down at the bottom, much like your receipt at Kohl's or Heb or Smith would be, right? So now you're taking it and you're bringing it down to something that they know, and they can feel comfortable being like, oh, I know this. I know how to read. I know how to read these things. I know what I'm doing.
Yep. King Soopers, that's my favorite because I never put my loyalty number in until I've scanned everything, because then I'm like, woohoo!
Look at how much money I saved.
Yep, exactly. Great example.
Now I'm going to totally try doing that now at King Soopers.
Yeah.
It's a fun game.
I need some entertainment right now. That would be fun for me right now.
Okay. So, going back to switching it, okay? You can, every lender is different about when and how you can do this, but like UWM and Remen, you can make this change in closing. You can get a balanced CD and be like, oh shit, we're short cash to close. We're going to need to flip this bad boy to borrower paid and we need to get some credit going. They don't like it all the time. UWM, you do it yourself. You might have to wait an hour or two for somebody to go in and do the actual change. Okay. But as a practice, so for me, as a practice, I always submit borrower paid, even if I know, like, I maybe like right now, right? Like you can price a loan, you have to submit it before you, and it has to be approved before you can lock. That's just the environment that we're in. You can't most places you can't pre-lock and then submit. Okay, so what happens if the pricing changes while I'm waiting for underwriting to come out and now my rate has a cost where before it didn't, and the borrower is like, you're not gonna be able to change the rate on that borrower. You're not gonna be able to have that discussion with them, okay? You can request the change in compensation to borrower paid. And what you're going to see is on the loan estimate or the CD, Well, 4, it's going to be over here is paid by others. And listen, don't be afraid of this. Do not, you guys, I spent so much time being afraid of this and people being like, you're making how much freaking money? Yeah. Okay, listen, because what I want to be like is like, yeah, bitch, because I work for 45 days with people before I even get paid. And there's no guarantee I'm even going to get paid. Like, don't come at me like that. Like, here's the deal. If you're at a house that's 400,000 and the real estate agents are making 2.8 or 2.5, they're making $5,000 each or 10,000 each, right? But if the borrower puts 5% down,
And none of that's paid by the borrower anyway.
right, none of it's paid by the borrower, I'm getting 2.5 of this. So I learned along the way, especially when I was talking to borrowers, I would just tell them, like, I get a percentage of the loan amount. It's very similar to how your real estate agents work. They just get a percentage of the actual sales price. So push come to shove, I'm actually the least paid in the transaction. Then they're like, oh, I don't really care what this number is, right? So what you're going to see here is so if it's 400, but first, because this is easier math for me, okay? So our loan amount is 400,000. You're going to see this over here. You're going to see that. Don't be afraid of this. You know, my husband tells me a story all the time, and Tyler, you've heard this before, right? Like, so my husband tells me this story about, so he is a master, like legitimately has his license and whatever, but he's a master plumber and a master HVAC technician. But he is so well known in his industry, he literally is considered, we would call it a SME in lending, a subject matter expert, or in tech, it's called a SME, so a subject matter expert, SME. And he tells me this story about how, like, you know, you go into somebody's house and they tell you the story and whatever, and you go in, and I should have him like guest appear and tell the story. But anyway, short version, you go in, the pipes are banging, there's all this noise, you go in, turn the wrench, knock on the wall 3 times and it stops, and you go, okay, great, that'll be $369. And somebody's like, you turned the wrench a half a quarter and knocked on the wall 3 times. What do you mean it's $369? And the value is you're not paying for the 10 minutes, you're paying for my 20 years of knowledge to know that all I needed to do was turn the wrench and knock on the wall 3 times. You're not paying for my 10 minutes, okay? If you are an originator, you have 20 hours of education. You had to take an exam at a proctored testing facility at the same place that nurses, doctors, and lawyers have to take their exams. That's how serious this is. Okay, you hold, in whatever state, but you hold a $50,000 bond that probably costs you a couple $100. I hold a $500,000 errors and omission insurance. You expect to pay an attorney $200 to, I don't know, what, $400 an hour. Imagine what it would be for an attorney after 30 to 45 days at $200 to $400 an hour. So don't sell yourself short, and don't be afraid of this number over here. Because until you close that deal, you are working for free. And I've had clients that I've had to work with them for 3 months, 6 months, a year before they were even able to qualify. This is less than $1,000 a month for working with that person.
Yep.
So don't let this over here scare you. Know that you are valuable and you deserve to have this. Okay? So in regards to going back to our conversation, what you're going to say to the customer is, listen, this is my contracted rate. It's a percentage. It's the same. You normalize it. It's the same at all my banks. I don't get paid any more or any less than any of my other banks. Well, except for Angel Oak, because they only do the bank statement loans, and that's not you. And don't worry about that. And I get paid less there anyway. I don't like using them. Okay? But you just let them know, listen, this is where it starts to get funny money. But this number that you see over here, I'm actually going to move it over to here, and then I'm going to make it smaller. Okay, I'm going to make it smaller. And because we can't, if we don't lower the rate, right? If we don't lower this rate down to this one that we need, we're not going to be able to do the loan. This one gives us enough credit to cover this. This one does not. So what I'm going to do is I'm going to move this over here. And the money that you were going to use to pay all these other things in B and C and D and F and G over here, all the money you were going to use, we're going to actually apply it to here. And then the credit that they were going to give you that's down here, we're going to take this money and apply it to B and C and D. And I know it's a little bit of funny money. I know it's like playing Monopoly with my kids. Like, I hate it, but I just, I want to at least give you a little bit of an understanding. But, if you trust me at this point, just know I'm going to take care of it for you. If you have more specific questions, I'm happy to answer them for you. But I at least wanted you to know before I send the paper out that this is the changes that you're going to see. Because if you don't say that and then all of a sudden they see $8,000 here, you bet your ass you're getting an angry phone call from somebody.
Or worse, they'll share it with other people and then,
yes,
move the loan from you.
This is also why when you're in a group setting, like in vetted VA, right? Like, we have to say things like, I don't really, somebody posts their loan estimate, they're like, is this a good rate? And we're like, I don't know, what's your FICO? What's your loan to value? What's your, what program? I mean, we can kind of figure out what program, how long are you locked for, right? And so it's really beneficial for you to say and teach people, your clients, even if you're a processor, to teach people that there really is a lot that goes into it. Trust me, I wish it was that simple, because then I could help more people, but we actually need more information to get down to the nitty and gritty on that for you.
I remember when that person posted that too, and the guy got so upset because nobody would give him a straight answer. Yeah. And everybody's like, you just don't get it. There's so much more that goes into it.
Yeah. Right. But now you know that too. And now you know that it's okay. The biggest concern is feeling like we're being sort of sleazy salesmen or something at some point, because we're not going to answer that question directly, because we can't. And when I first started, I kind of was a little bit insecure about it, and I would say things like, I know, I'm not trying to be like a sleazy car salesman or something, but I can't give you that. But the issue isn't that if I say that I can't, it makes me sound incapable. I can say, oh, that's awesome that you know those things. There's actually about 5 identifying bullet points, sometimes 6, that determine all the pricing for the rate. And I educate people all the time. I also tell my clients, I'm probably not going to call you when I lock your loan. And they're like, oh, I'm like, okay, y'all, all locking a loan does is secures you to the active pricing sheet, regardless of what you do with the loan. It doesn't tie you to the rate. It ties you to the sheet. So if I only have an hour, because y'all know sometimes you get an alert to float and you float that bad boy, and then all of a sudden 20 minutes later you get an alert to float. You don't have the time to call everybody. So I always tell my clients when I'm getting ready to submit them, if we're submitting on a float, I say, hey, I just want to let you know, this is my policy, this is my philosophy on locking. If they don't like it and they don't understand it, then I know I need to address them differently, but I just let them know, like, hey, I just want to let you know that I'll be watching this. If I see an opportunity to lock the loan in, I'm going to lock this for you. It doesn't tie you into anything. What it does is it secures that pricing sheet to your deal. So no matter what we do, we just have to make sure we use that sheet. So the important part is that I get us tied to the sheet. The important part isn't really the rate. I mean, it is, but I'm not locking the rate in for you. I'm locking the rate on that sheet. The important thing is that I'm locking us into the sheet. How many times do you think that person was told that?
None.
Now, yeah, and I will tell you that this is the feedback that I get the most, is people are like, nobody's ever explained that to me before. That's okay. It's just how it works. I mean, if you would have asked me 10 years ago, I wouldn't have been able to explain that to you. I thought you locked in the rate. And then they don't feel like, I don't want to lock the rate in because I don't want to be trapped into something. It's bad. No, it's not bad. We can change it. And I tell people, listen, you're not, until the money transfers at the end, you're never locked into anything. Nobody's going to tell them that. They're going to scare them, be like, well, you don't want to lose this and you don't want to. That's fine if that's your tax. If that's what works for you, that's fine. It's just what I do. Because what happens is when they, if by chance they start speaking to somebody else and they start saying those things to them, they're going to be like, I know that's not how it works, and now I don't even trust you. I actually had a call with a client yesterday who was referred to me. She was like, I put my information in Lending Tree and I'm regretting my life right now. She was like, and I was like, I get it. Like, that's how I started in the industry. That's what we used to get, was Lending Tree leads. And so I know the spiel they're telling you because that's what I was taught. So I totally get, if you have any questions, I'm going to shoot you straight. Like, it's why I chose to be in broker. It's because what I realized when I was working at places like that, like the people that are calling you, even what I didn't understand at the time was that if I couldn't do a loan for you, I just assumed that meant you couldn't do a loan. And that's just not the case. And that's why I chose to be in broker, because I know that if one of my banks want to approve the loan, I've got 10 others that I can try and do it with. Or I know that we have other options available. So I choose to be in broker because of what I've experienced in here. You may not have the same experience that I do, but you can say, like, I really enjoy working in broker because I know that if I worked for a retail lender or a direct lender, we wouldn't have the options we have available. Sometimes I explain to them, like, listen, I have one bank that doesn't do anything under 640. Okay. I've got another bank that will go down to 550. So if I'm doing a conventional loan for you that starts at 620 and your score is 660, and we go in pricing buckets, just go with it. Just go with it. Just, okay. If I'm here, right, then this is the first tier. And this is the second tier. But if I go to this bank on a conventional, this is first tier, this is second tier, this is third tier. So what do you think the chances are that my pricing is likely going to be better here than here?
Can you repeat the last sentence you just said?
What do you think the likelihood? So this side is this bank. This side is this bank. Okay, so at this bank, they don't do any loans under 640. So this tier of pricing, 640 to 659, is the first tier of pricing. Then the next tier, this is the second tier at the 660. But at this bank, because they go all the way down to 550, which means they start conventional pricing at 620, this is the first tier of pricing, this is the second tier of pricing, and this is the third tier. What do you think the chances are that my pricing is going to be better at this bank versus this bank? Where this is their third tier of pricing, and this is only their second tier of pricing. Does that make sense? Or no? Explain it a different way? My husband's saying yes, but I don't know what he's saying yes to. He understands.
Somewhat. I think with time, it's just getting a little confusing, but with time, I mean, I'm kind of getting it. It's kind of.
Let's do it like this. Here, let me do it this way. Okay. We have a borrower that has a 620 score or 660 score. Okay. I always write over that. Okay, that's good. Okay, so Remen and UWM. Okay, so when we're talking about loan level price adjustments, right? If UWM doesn't do anything below 640, their pricing starts at 640 to 659. And then, so let's say this is a 0.50 credit adjustment. Oh, you can't really see that, can you? And then this one is 660 to 679. And let's say that's only a quarter price adjustment.
Okay.
But at Remen, they go down to 550, which means on a conventional, their pricing bucket starts at and let's say this is the 0.5 hit. And then the next bucket
Okay, got it. I got
right?
it. Yeah.
Okay.
Yeah.
So just for this parameter of credit score, I'm probably going to get better pricing at this bank because they do loans to the lower score than this bank because this is their first level of pricing.
Yeah. I totally get it now.
Okay. Okay, so we're probably going to end a little bit early today, but does anybody have any questions? Anything they want me to revisit or something that they feel like they're just still not quite comfortable with that you would want me to go back over again? Or something within the realm of this that you would like me to go over?
I'm good.
I'm good, thank you.
Mm-hmm.
It's very helpful. Thanks so much,
Mhm.
Jackie.
Yes, extremely helpful.
Claudia, Tyler, Jamie,
I'm good.
okay?
Yes, I'm excellent.
Okay. Now, most of what we talked about today will be done for you by technology, but you have to understand this in order to know how to manipulate the data inside of the lender platforms. Okay, so quick tips. Always look at your pricing and look at what your loan level price adjustments are, right? This was over here on the right. Most of the time, you're going to have LTV requirements or changes in pricing every 5% in loan to value. So if you're pricing your loan and it's 75.08, see if you can drop that loan amount to 75 loan to value. It will affect your pricing.
Gotcha.
Okay. If you are at you know, like I said, credit score is every 20 points. So if you have somebody that's sitting on the edge, if your company allows, maybe you spend the $8 to find out what the rescore options are. I've literally had a client who all they needed to do was take $24 on one credit card to have 27 points increase on their credit score.
What are the rescore points? Are those the ones that were the credit? You have the credit, and then underneath it's got like a little number.
Yep.
Okay, so you actually, when you look at the credit report, that's one of the things that you look at.
So you can look at the number. You actually have to pay about $7 or $8 per trade line to find out. So it's what it's telling you is, so what she's talking about is on a credit report. So you're going to see like, it's going to be different in each vendor, but you might see something like this where it says 637, 642, and 52. And then you're gonna see like a little, like plus 24, plus 18, and plus 30, okay? That's kind of small, sorry. So what you would do is you can click on this here, and it'll take you back to the credit agency, and you can do what's called a wayfinder. Or what if, okay? If you do the wayfinder, you click this and you go in and you say, well, what do I, so let's say it's this one. What do I need to do to get, this is actually a bad example. Let's do this, 630, okay. Let's say I really want the mid score to be 640. So our mid score right now is 639 because it's the median, it's the middle of the two. Not just because I wrote it in the middle, it's because it's literally the middle number, okay? But let's say that I want the middle score to be 640, so I know that I need this middle score to go up by one FICO point. I can click on this little, depending on your credit agency, but in theory, you would click on this little thing and it's gonna take you to Wayfinder or What If. Wayfinder, you're gonna be like, hey, find a way for me to get to 640. And it's gonna print you a little report. It's going to tell you what you need to do on that person's credit profile. Now, listen, if you're more than like 10 points or you're like off, it might not be in your best interest to spend the time, and you may want to find someone to refer them out to. But I will tell you as an individual, this single-handedly is what grew my business. I don't have the time anymore to do this. I would have to hire an individual to monitor these clients, do this for them, and walk them through it. But I will tell you, if you want an opportunity to grow your business, you look out for these two things. If you have a real estate agent partner, or you talk to somebody and they say, oh, I just need to wait 6 to 12 months and I have to pay down my credit cards. My first question is, oh, that's great. I'm glad you talked to somebody. Did they tell you how much exactly you need to pay your cards down to get your score up? No, they just said I need to pay it down. That person met with a lazy loan officer who didn't want to do the work. You spend the $8, you invest $8 in your client, and you say to them, hey, Mr. Client, I really want to get you up to a 640 because I can get you a better pricing for the rate. I did a wayfinder and it says you need to pay $162 on your Cap 1 card. Is that something you think you can, because I think that it could, or based on the pricing at this bank, it can save us, or we can, if you go up to 640, we can get a lower rate. Or for the same rate, it'll flip us to getting a credit, and you're gonna get more credit than the $162 that you need to pay down the Capital One card, okay? Or like right now, it's gonna be hard to find a place to put them right now. And let's say you really wanna get them up to a 660, like you might refer them out to Sam Parker at My Credit Guy, but you might just do this wayfinder because they may have said, oh yeah, well I met with so-and-so and they said my credit's not good enough yet and that I have to be a 660 and that I need to pay down my cards and wait 6 months. What if they were my homie that needed to pay $24 on his Cap 1 card to get his 27 points? Why would I make them wait 5 months? How pissed would you be if you knew you only had to pay $24 or $162 on one of your cards, and you could have done that a month from now, 2 weeks from now, 5 days from now?
Once they pay, Jackie, how long does it take before you can do the rescore?
Okay, so doing a rescore,
or whatever, so that you can show the new score?
Things, if they do a rescore, you want them like basically next day to provide you an updated, like, I always hesitate to say screen print because you're literally going to get like a Control-Alt print screen print, and we all know that's not good. You want them to provide you a PDF of their account showing that the payment was received and that their balance was reduced.
And then just
Normally,
provide that to the credit company?
yep, when you order a rescore,
Okay,
you're gonna
cool.
upload that. They're going to call the creditor and verify, and then they're going to push that through.
Sorry, my
No,
dog.
sometimes what I ask them, like, let's say they've got to do this and they need to save a little bit of money because they don't quite have it all together yet. What the rule of thumb is you ask them, when is your payment due? So if their payment is due on, let's say their payment is due today, okay? You could have them make an additional payment today and then give it 2 to 3 days. Because the credit agencies usually, the credit company, the creditors usually update within 24, 48, 72 hours after the payment is due, right? Because they want their money, and if you haven't paid them, they're going to update your status as past due, not late, just past due, right? So if you can catch it within their billing cycle, like right at the end, like let's say today's their payment, but you talked to them a week ago, you might say, hey, it costs money to do the rescore. So that's the big thing, is it costs money to do the rescore. Your credit's going to update next week anyway. Let's have you make the payment, and then next week I want you to log into Credit Karma, or I want you to log into your banking system, and let me know once you see that account has been updated. Like, those are just tricks of the trade that help you not spend a lot of money. But honestly, like, if you're in the middle of a deal and you need that to happen right now, you just got to pony up the money for the rescore. So like right now, while if you're originator in here, you probably have a lot of people that are reaching out to you that are on that cusp of that like 620, 640, where it's really challenging to do a loan right now just because of the environment we're in. Get them on a rescore plan, get their income docs in, get their whatever in, get a full file. Give them a 30 to 60 day plan. Tell them exactly what to do. Print the Wayfinder sheet for them and give it to them so they know exactly what to do. So I actually, when I'm talking to realtors, and I said this before in a previous class, I don't like, I handle realtors in a little bit of a different way because I don't like the way that it makes me feel trying to be somebody's primary lender. It makes me feel like I'm in middle school again, trying to be a part of the cool kids group. That didn't go well for me in middle school. I don't like it now. And the other thing is like when somebody tries to come in and tell me the thing that I'm doing successfully isn't working, or I should do it with them because it's better. I'm like, right, because me and my homegirl over here, we did like 9 million last year. How are you going to come in here and tell me that it's no good, right? So my approach is a little bit different. When I talk with realtors, I let them know like, hey, I don't want to be your preferred lender. I know you have a BFF. And right there, they're like, wait, what? So first of all, they're like, what do you mean you don't want to be my BFF? Every lender wants to be my BFF. And what the hey, you don't want to be my BFF? Why, what? Who are you? Why do you not want to be my BFF? And I'm like, oh, no, it's not that. Like, I want to hang out in the cool kids club. But what I want you to do is keep doing what you're doing, right, with your preferred lender. What I want to do is I want to see anything that your preferred lender basically says no or gives them a 6 to 12 month timetable. Those are the ones that I want to take a second look at for you. Okay, my goal is to help convert one of those no's from this lender into a yes once a quarter for you. So in Colorado, where property values are a little bit higher, if I can do that once a quarter and we're at like, and this is on the really low end nowadays, but like, let's say that that's a $250,000 deal, that's $1 million a year. And if they're taking home, let's say they're taking home 2% after their brokerage split, that's a $20,000 raise just for them, allowing me to look at the stuff that their lender said no to. And then I say to them, then I'm not coming into your office with bagels and donuts and asking what you got in your pipeline. You got anything you want to refer me? No, they're calling me. If your lender gives them a 6 to 12 month time frame and it's not related to like a bankruptcy or a foreclosure, I'm going to talk to them. I can probably turn that for you. That's why I choose to be in broker, because I love the optionality that I have that I can give to clients.
That is so awesome.
Okay, so then you're not putting yourself in a place to be rejected all the time either. Like, nobody likes that. And I get that it's a part of sales. Like, I've had some serious sales training in my day. But I don't want to have to convince you how good being a broker is. I know how good it is. That's why I choose to be here, because I'm not a fucking idiot. Okay? You don't know that, and that's okay. I choose to do it because I love the optionality. I've worked on the other side of this and I didn't have the optionality and I lost a lot of deals. I know how hard you work as a real estate agent to farm every relationship. I know how hard realtors nurture their clients. I do the same. And I've had clients that I've worked with for an entire year before they were ready to buy. And what we do is we nurture them, we grow them, we tell them exactly what to do, and when they're ready, we send them back to you. Easy as that. Who else is doing that for them? Who else is doing that for that realtor? If they farm this relationship, they finally get the borrower to call their lender and the lender fucking says no. What are they going to do now? I want to give them the option to have somebody else to talk to if their preferred lender says no. And then I'm not bad-mouthing anybody either. Because you know what happens when you bad-mouth somebody? The first time that a deal goes south, everybody's going to have something to say about it. And it happens. Deals go south for sometimes of your mistake and sometimes not. And the next thing you do is you go to closing and you bring a gift for everybody and you make them talk shit to your face with gifts in hand. Except for nowadays in COVID, then you don't go to closing. That's frowned upon. Okay, that's it. That's my soapbox for today. Any other questions before we sign out?
Nope, that's awesome.
No, it's good. Thank you so much.
Yep. Hey, Ty, hang tight as I let everybody out.
Okay.
Oh, I have a quick question.
Yeah.
Let's see. You provided a link in the group chat at the beginning of the session. What was that link for?
Oh, somebody asked how they could share the link to the Zoom call today.
Oh, cool. Thanks so much. I'll see you tomorrow.
Okay, sounds good. Bye.
Thank you, Jackie.
You're
Okay.
welcome. Bye, guys.
Bye. Thank you, Jackie.
Oh boy. Hold on. People are still. Oops. Cancel. Okay. Do you guys have any questions?
Now, the whole like going from lender paid to borrow paid kind of jacked with my head a little bit, but having run through it like 3-4 times, that helped me out a lot.
Well, but here's the thing. So it's going to be hard if you're not working on an actual deal. And the idea is to at least get you exposed to it. So that way, when you have a client in hand and you're trying to do this, you're not trying to learn all of that at the same time you're actually trying to do it with a client. So it's okay. It's totally okay. Now that you've heard that, when and if you have a loan where you would actually need to do something like that, you're going to have a really solid understanding of what we're trying to accomplish, but every deal is going to be different. But now you know that, like, the biggest thing is, like, I wouldn't ever want someone to be like, well, the only rate that I can get to cover this is 4.25, but that rate kills the deal, right? You know that you have the option. You could come to me and say, hey, I got this deal. It's really tight. The rate's not going to work. What do I do? Like, how can I do it? And I can say, like, oh, hey, let's look at going borrower paid on this. Like, I've got a deal right now. They're repeat clients of mine. They're kind of in a tight situation. And we're only going to make, I think after yesterday, we might make $2,000 on the deal. Our regular compensation would have been in the neighborhood of $8,500. But I'll get referrals from her because she knows that we took care of them. She knows that I reduced my compensation to make sure that this could happen for them, right? And she's going to want me to take care of people that she knows the same way that I took care of her, which is why I did a deal for $300, even though it was my mistake. So, And then the more important thing is to know how the math works, because if you don't know what you're trying to do when you're trying to find a rate, and you got to find a rate to put on the loan amount to see what the payment is, to see what they qualify, right? That's like the lowest common denominator of the thing that you need to figure out how to do in order to get a payment over to them and in order to make sure that they're going to qualify for the loan. So I know it's a lot, but I also feel like, you know, Ty, you sat next to me for like, you know, almost 4 or 5, I don't even remember, 4 or 5, 6 months. What I'm hoping is that being in these sessions kind of helps you connect the dots with a lot of stuff that you heard and saw. And so the next couple of loans that I have coming in, you know, I'm going to have you guys start jumping in and seeing and doing some stuff on them so that you can really see what's going on in the back end and how to actually do it. That's not something I will do on a big platform for everybody. Just because, I mean, we're going to have access to clients' information, and so it just wouldn't be appropriate to do it in a forum like that, but so that you can begin to get some working knowledge on how it actually works. Okay. Cool. Claudia, I have, so I've got most of the trainings from last week posted on YouTube. I've got yesterday's and today's that I'll get uploaded, and then I'll send you the link, and you can just catch up on those whenever.
Okay, yeah, I just need just wondering about the link where I can go look at it. And I'm not, just last week is the one that I missed, but now on, I'm just going to be taking that time off to be in the training.
That's fine. Well, you have, you know, you can always email Isabel too, like if you have specific questions, like if you watch a YouTube and you don't understand something, you can email me and Isabel.
Okay, and then did you get my email?
If you sent it this morning, no, because I haven't checked any emails before I got in session today, because we had a loan officer have a fire on a deal that I had to get fixed before I jumped on today.
Okay, I just not too sure if it's working. Because like when I register, for example, when I register for this, I received the confirmation and it automatically disappeared. So and I'm not getting any of it on my phone. On the computer, it's really, like I can't find anything. It's just really weird. And it says inactive. I send that to you in the email. So
I'll have Brian look at it because he kind of handles all that stuff now. So I'll let him know to jump in and take a look at it. I know I had an issue on mine about a week and a half ago. I'm wondering if that's just more of an issue with what I had and he needs to do something with your account the same. So I'll let him know. Brian, did you hear that? I'll make sure he hears that.
yeah, and then on that email, if you got it, I did put what it shows, and I took a couple of pictures showing you what it says. Yeah, it's just really, really weird because my buttons I can't use them. Like I can't reply, I can't send anything.
Okay, I'll have him get on that today. So I don't know if I got your email or not then, but I'll look as soon as we get off this.
Okay.
Claudia's,
I had another.
Claudia's email isn't working. She's unable to like reply or receive or anything. She said it shows inactive. But I'm wondering, remember when we did something lost and like my email was like, everybody was like, your email's bouncing back. Yeah. Okay, thank you. All right, guys, well, that's all I have for today. Tomorrow is a processor training. And then today I'm gonna kind of take a look over the pipeline and see if we can schedule a time to work with you guys on individual stuff.
Are we being on that training tomorrow? No.
If you want to, it's a processor training. I mean, you're trained to come on as an originator, so like I invite you, if you didn't have the time or didn't want to, I would say it's not really necessary.
Okay.
Okay, I'll talk to you guys in a bit then.
All right.
Okay, bye.
Bye.